We've been discussing the steps involved with auditing the revenue and collection cycle. In the last video, we discussed the second step, identifying significant accounts and relevant assertions. The next step is to assess the risk of material misstatement. Remember, the risk of material misstatement is a function of both inherent risk and control risk. The auditor therefore needs to do two things: assess inherent risk for revenue accounts and assess control risk for revenue accounts. Inherent risk is the risk a material misstatement will occur in the absence of internal controls. Now, there are 4 factors that affect inherent risk for revenue. Let's start with industry-related factors. An auditor should always look at trends in a client's industry when assessing inherent risk. If the company's industry is in decline, for example, there might be pressure to overstate sales. The next factor that affects inherent risk is the level of complexity for recognizing revenue. There are more likely to be disputes between the client and the auditor if the revenue recognition process is complicated, perhaps due to multiple deliverable arrangements, lease contracts, or installment sales. A third factor that affects inherent risk is the difficulty of auditing transactions and account balances. Simply put, some accounts are more difficult to audit than others. For example, what if the client launched a new product? There wouldn't be any data for prior sales returns. This would make the estimate of future sales returns somewhat subjective. The final factor affecting inherent risk is misstatements from prior audits. Would you trust a client who overstated revenue last year? Clients who improperly recognized revenue in the past are more likely to do so in the future. I know this material isn't too exciting, but hang in there and don't change the channel. We still need to talk about control risk. Control risk is the risk a material misstatement would not be prevented or detected by the client's internal controls. Assuming the auditor plans to rely on the client's internal controls, there are 3 steps for setting control risk. The first step is to understand and document the client's internal control process. The auditor should gain an understanding of the 5 components of internal control. For example, when assessing the client's control environment, the auditor should determine whether the audit committee takes an active role in overseeing the internal control process. The auditor can then identify where a misstatement might occur and determine whether a control is in place. The second step is to plan and perform tests of controls on revenue transactions. The auditor can test the controls by talking to the client's personnel, inspecting documents, observing the control being applied, and reperforming the control. The final step is to set the achieved level of control risk. Here's how this works. After testing the controls, the auditor compares the achieved level of control risk to the planned level of control risk. If the achieved level exceeds the planned level of control risk, this means the auditor can't rely on the client's internal controls to the extent the auditor had initially thought. Thus, the auditor will need to perform additional substantive procedures to keep audit risk at an acceptable level. Finally, now that the auditor knows both the inherent risk and the control risk for revenue transactions and account balances, the auditor knows the risk of material misstatement. Remember, the risk of material misstatement is the risk that a material misstatement will occur and not be prevented or detected by the client's internal controls. A high risk of material misstatement means the auditors will need to set detection risk lower to achieve an acceptable level of audit risk. And that's it. I hope you enjoyed this tutorial. More auditing videos are on the way.